First thing is that if you look at this cash flow for the period, it has some problems for us. And basically, it is that if we try to calculate the internal rate of return of this project, it might generate a mistake. For instance, these $20 million are the excess that we asked in debt to invest $40 million in property, plant, and equipment. Let's try to look at the number we will reach if we calculate the internal rate of return, and let's see what this number yields. So as you can see here, it is not able to calculate. It's not able to calculate the internal rate of return. So in order to solve that problem, people in finance created a special different cash flow called operational cash flow. And the operational cash flow is very different from what we have here. So let's take a look at the operational cash flow. The operational cash flow is different in terms that it does not start from the net income. Rather, it starts from the earnings before interest and tax. Why does it start in a subtotal that's before interest and tax? Well, mainly because if we take this $60 million and its related interest, we have the problem that we're trying to solve in the first place. So we need to find the earnings before interest and tax. Let's go to our model here, and if you look at this operating profit, it is the same name. It is the earning before the interest and tax. So this subtotal here that we're going to take, this number here, is the earnings before interest and tax called EBIT. And this number, this EBIT, is the basis of the operational cash flow. So in order to calculate the internal rate of return or the net present value of a project, we need to calculate the EBIT. In this particular case, we then need to find the tax. Here is a common mistake you might want to avoid. Usually people take the tax from the income statement, this number here, but that is a modeling mistake. You cannot use this tax here because this tax here is contaminated by this interest. And what we're trying to find here is a cash flow that is totally operational. Hence, that's why we took the earnings before interest and tax. So we cannot use this tax here. What can we use instead? We can use here, let me show you, we can multiply these earnings before interest and tax and multiply it by the tax percentage rate. In this particular case, these taxes that are different from the taxes calculated above are higher because they do not consider the benefit from the debt of the project. So we move to the right, and we then need to calculate a new subtotal that is called NOPAT, or net operating income after tax, net operating income after tax. People from accounting backgrounds do not recognize the net operating profit after tax, the NOPAT, because it is specifically a concept created for financial professionals that work in project financial evaluation. In this particular case, we take the earnings before interest and tax and subtract the tax, and we get the NOPAT, or net operating income after tax. Something particular about this new subtotal that we are seeing right now is that in the case of Professor Aswad Damodaran from University of New York, is that he doesn't use NOPAT. He always uses this equation as a way to name the NOPAT. So if you like to read the material from Professor Aswad Damodaran, which I highly recommend, He has 850,000 followers on YouTube. And if you want to dig deeper into the valuation world, one thing you can do is go to his YouTube. Here are 882,000 subscribers for this topic of equity valuation, company valuation, which talks about the popularity of this topic. And then if we go here to lists, then you can visit this specific playlist for valuation that has 25 videos on company valuation. In those videos, you will not find the concept of NOPAT, but rather what you will find is this equation, and they're both the same. EBIT times 1 minus tax rate. This is what we're calling here NOPAT. So let's go here and calculate this equation just to show you that the number we will get is the same. If we take 9.4 million multiplied by 1 minus 33%, we get the same result. So just take that into consideration. What we will call in this class NOPAT, or net operating income after tax, Damodaran calls EBIT times 1 minus the tax rate. But they're both the same, just so you know that specific part of, especially when we're working on valuation. That's something that we're going to be talking about later. So we have here tax, operational. We need to add here the word operational, just so it doesn't get mixed with the tax that we have up there in the income statement. And we need to add all these other operating components that we have here. We exclude these both. We exclude both these items, new debt and debt payment, because they're financial. But if we take all these 5 components, depreciation, CapEx, which are investing activities, and the change in working capital components, which are operating components, then we will get what we call the operational cash flow. Again, the operational cash flow that we're calculating here is not the same as the operating cash flow we would get in a traditional accounting. In the traditional accounting, what they call operating cash flow is in our model located right here. Right here. This total right here is what in traditional accounting, or in Yahoo Finance, in the case of Pfizer, this is what we call the operating cash flow. This is what they call the investing cash flow. And this is what they call the financing cash flow. So let's open these 3 just to let them, just to have them here, and to remind ourselves that these 3 cash flows are not the same as the one we're calculating below. In the future, when we're working in valuation, we will notice that different types of valuations work under different subtotals. For instance, there's one way of valuing companies called free cash flow to equity that use both these cash flows. And there is one called free cash flow to the firm that uses this cash flow. All those things we will discuss later. So for now, let's just document here the net income plus depreciation minus change in working capital. This is the operating cash flow, correction, operating cash flow. This one here is the investing cash flow. So what I'm trying to do here in this model is just basically try to make our model look very similar to the information that you will find in Yahoo Finance in case you want to continue working on financial modeling of companies that are traded in the stock market. In that particular case, you need to download all this information from Yahoo Finance, then go to visit the 10K and the 10Q reports and create and consolidate all that information into your financial model. Then you forecast the dividends, get the present value of the dividends, compare it to the market capitalization, in this particular case, $125 billion, and then you get to decide if you purchase or sell the stock, and then you, after some time passes by, you compare what you said in the model with what happened in reality. So let's continue. We have here the investing cash flow, and we have here the financing cash flow, which are the three components of traditional accounting cash flow. But that's not what we're doing here at the end of the model. What we're doing here at the end of the model is calculating the operational cash flow in order to get the internal rate of return. Just remember what we know so far. In financial models, you need to have units. That's why I'm working here just to get these units here. And if a subtotal is more important than the others, you might want to use maybe just some way to highlight it, in particular, in order for the person that's receiving the model to just maybe focus their attention on some subtotals that are more important than the others. So maybe this format might be useful. Here, if we go to the operational cash flow, then we're going to be able to obtain the internal rate of return and the net present value. I happen to know, for a reason, someone that's in this class right now, that where he works, I'm not going to say his name out loud, but where he works, they combine these both cash flow statements into one. That's a bit more difficult than what I'm doing here. What I'm doing here is I'm breaking it into two different cash flows, the accounting cash flow and the operational cash flow. But I know someone who combines both into one. And the difficulty in that particular case is that the taxes that you have here are $3.1 million. And the taxes that you're using here, that we used for closing the financial statement, is a lesser number, is $726,000. So if you know who you are, then in that particular case, you're going to have to check this model and the models they work and the models they do where you work, because they combine them in both. I don't do that. I break them into two different cash flows, but it doesn't mean that they're wrong. It's just that it is more difficult to do. That's the main difference. So let us take here the difference in working capital. So increase in account receivables. Most people combined these movements into one, same as when you look here at Yahoo Finance, and then you go to financials. You might have noticed you might have noticed before that this cash flow that we have here as operating cash flow, and then we open here, has the change in working capital classification. But if you open it again, then you see receivables, inventory, and payables. That is what I like to, the detail that I like to open it, particularly because it's different to have a liability than to have an asset, as we talked about before. Then we move to the right, and we have here the change in working capital. And then we add here the increase in property, plant, and equipment, the CapEx. We're probably missing from this model the recurring CapEx, which is something probably a lot of people would ask, is we need to keep investing in order for the property, plant, and equipment to not decrease all the way to zero. And that's something we're going to be talking about later when we upgrade this model a little bit. In here, we have the NOPAT, or net operating profit after tax. I'm going to just change here. It's not income, it's profit. Net operating profit after tax, which is called NOPAT, or the way Damodaran uses it in his videos, EBIT times 1 minus tax rate. And then we move all the way to include the CapEx. So we have NOPAT plus depreciation minus CapEx. Take into consideration that Damodaran also uses another thing that you need to be aware of, which is a concept called net CapEx. We are not, but yeah, in Latin America, we're not that used to use the concept of net capex, but I think it's important, is the difference between capex and depreciation. So in this particular model, we have a net capex of $40 million. Makes sense since we're already we're investing in the first year of the project. And then as we move to the right, we have a net capex that is negative. A net capex that is negative means that you are depreciating more than you are investing. So if you want to read Damodaran's material, what you need to take into consideration, either reading his documents, or if you want to watch his YouTube videos, or perhaps you want to work more into valuation and you want to take the advanced valuation class in NYU, then in that particular case, you need to know that the way he calculates an operational cash flow is through this concept, EBIT times 1 minus tax rate, minus the net capex, minus the change in working capital. So it's different, but the result is different. It's shorter, that's for sure, but the result needs to be the same. This is the operational cash flow. Since Damodaran works mostly on valuation and not so much on project financial evaluation, he calls this total free cash flow to the firm, in reference that this cash flow is owned by both the liability holder, the banks. I mean, this cash flow is owned by the banks and by the equity owners. So in valuation, when you see free cash flow to the firm, especially in Damodaran, what he's referring to is what we traditionally have been referring to in our previous studies as the famous operational cash flow in project financial evaluation that, let me remind you, is different from the operating cash flow in the cash flow statement. Hope this is making sense. So let's move here to our operational cash flow. Operational cash flow. Actually, this name should be called operational and investing cash flow. I don't know why it's called only operational cash flow. It combines both operational and it combines also investing activities. So it should be called operational and investing cash flow, but for some reason, it's popularly known as operational cash flow. Actually, it's called operational free cash flow. I was forgetting about the free. Free for who? Free for the owners of the company and the banks, considering that it's paying the highest amount of taxes that a project can possibly pay. So we have here the operational cash flow, and now we're able to calculate the internal rate of return. We're not going to have the problem that we had before. In the previous exercise, when we tried to calculate the internal rate of return using the cash flow statement that we used for closing the balance sheet, we got a mistake. We got this here. This is the cash flow period, and we got a mistake, but not anymore. Now we have a project, and that project has a return, an annual internal rate of return of 25.5%. If you remember your finance classes, this internal rate of return of 25.5% leads to the acceptance of the project only if this internal rate of return is higher than the weighted average cost of capital. That is the average percentage demanded or required by both equity investors and the banks. And if you compare this internal rate of return with the WACC and you get that the internal rate of return is higher than the WACC, then the board of this company can additionally accept this project, and then we have to go and find the financing of this project, which is the number that we have over here. In this particular case, we have somewhat of a difficulty in this model. For instance, we don't have recurring capex, and also we need to ask ourselves, what happens if after 2036 we have an operational cash flow of $14 million. We have a project that by now is basically a company in itself because it has a net income of $6 million, an operating cash flow of $9 million, is very close to finishing paying its total debt, and it also has $30 million in cash. So maybe, perhaps after years 2030 and beyond, we might think of this project more as a financial valuation, as a company valuation. So let us look at this particular model. In this particular model, we invested $40 million, but we're not happy with the recurring capex. We are probably happy with the way this is, with this internal rate of return. 25.5% is very high, suspiciously high, I may add. And then just let me show you something else that I was meaning to show you and I forgot, and is to get this same result, this same 40 million and 10 to 2298, using as what Damodaran's formula for the free cash flow to the firm that will be useful when we do our transition to valuation in the class that's happening tomorrow, actually. So we take EBIT times 1 minus T minus net capex minus change in working capital. We get the 40 million. Now let's move to the right. We should get $2.98 million dollars. Just let me double check why do I have a working capital problem here? Okay, yeah, I was forgetting about subtracting the working capital here. So let us do the full. No wonder we were getting internal rate of return so big, so high. It should be 15.4%. That makes more sense. And in here, we're going to take the change in working capital, excluding cash, because cash is the reason why we're building the model. It's not operational. Cash has interest in its favor. So let's take a look at the change in working capital. And let's go all the way up here, and we take this subtotal minus this one. Because the way working capital works is you take the current assets minus the current liabilities. So let us work into that. Let us work our way into that. We need to first create the working capital, excluding cash, and then calculate the change in working capital, excluding cash, which are both different concepts. We have here the working capital, which is current assets minus current liabilities. No wonder an increase in working capital is a cash outflow, because at the end it's just current assets. So we take here plus accounts receivable, assets, plus inventories, assets, minus accounts payables, which is working capital. Then we move to the right, and when we move to the right, this would be in the balance sheet. What we need is the change in working capital in the balance sheet. What we need is the change in working capital, that is the combined change between these three effects, between increasing current assets and increase in current liabilities. So let's move to the right, and if we're lucky and we take change in working capital excluding cash, and we compare it to the result that we got before, we should be able to get the same number. And in that particular case, in the future, if you do decide to want to read Damodaran chapter 15 on valuation, everything will start to add up. Everything will start to make sense, because firm valuation, which is valuing the operation of a company that it's owned by the banks and the equity holders, that's why it's here. The free cash flow to the firm is the sum of the cash flows to all claim holders in the firm, including stockholders, bondholders, and preferred stockholders. So if you look here, This is the equation that I'm trying to teach you. I'm using project financial evaluation to teach you operational cash flow, but operational free cash flow, but this will also be useful when we are looking at our valuation class, because there is one type of valuation called valuation of free cash flow to the firm, which is actually the most popular form of valuation, that will require us to revisit again this subtotal that we're looking at here. We got the EBIT times 1 minus the tax rate plus depreciation minus capital expenditure. And you're asking here, why doesn't it say net capex? Well, I've read Professor Damaran's material long enough to know that most of the times he just uses net capex. He uses net capex more than he uses capex plus depreciation. So that's why I warned you about the net capex concept. I'm pretty sure if I just scroll down here, pretty quickly I will find the concept of net capex. You see, it's right here. EBIT times 1 minus tax rate minus net capex minus change in working capital equals free cash flow to the firm, which is what in Spanish we might call flujo de caja libre operacional or operational free cash flow in English, not to confuse with operating cash flow. So let us continue getting the same result here. I will send you this model after the class. We have here the free cash flow to equity, so you can just compare with whatever you've been doing in the past. The change in working capital is the one subtotal that we're missing. This one minus this one. I thought I left it. Yes, no, is the change in working capital here. Is this difference or is this subtotal? So let me just get this subtotal here, and we get both the same result in the operational cash flow and the operational cash flow here. So let us just know that this is called free cash flow to the firm evaluation. I'm not sure in project financial evaluation if he uses the name operating cash flow. So let's move to the right, and we have here the same result. Ours is just longer and more detailed, but it's the same concept as the operational cash flow. A lot of people don't know that this special cash flow, this special operational cash flow, is used for the NPV, net present value of a financial model. Let's assume, for instance, that the WACC is 12%. I'm just going to write it here so we don't focus our attention or divert our attention into the CAPM or weighted average cost of capital. So just take these 12% as a hard input in the moment, and let's use net present value, BNA, a discount rate of 12%. The present value of all these numbers here should be higher than this number here. And that's the NPV formula. We get $47 million in present value minus 40 million in the first year. And we get an NPV that, if you remember your finance classes, it should be above 0 in order for the board to accept this project. This is the NPV criteria, and this is the internal rate criteria. So look, even though in the first part of the class we closed the balance sheet and we did a full final cash flow, this final cash flow was intended for the banks. This cash flow is intended as a feasibility criteria or as an acceptance criteria for the project. So let's continue adding more models, more modules for this project. First thing first, if we want to model 2036 and beyond with the terminal value that we used when evaluating Pfizer at the beginning of the class, then we need to add something called recurring CapEx. The recurring CapEx is a CapEx that takes place after, in a project, the original CapEx has taken place. So we take the CapEx and we need to build what is called the CapEx matrix. So what is a CapEx matrix? We take the recurring CapEx, which means probably when we incorporate this as a cash outflow, we're going to need to close the balance sheet again. So let's assume we invest, in order for this property, plant, and equipment to keep on working, we invest $2 million. And we take $2 million in this year and we grow that amount by 4%. Take this amount and we move it by 4% and move it to the right. So let's see what happens here. We have $2 million, then we move to the right, and then we get 2.80 million, 2.163. And the problem we face as valuators, as financial modelators, is that we need to do this same module of property, plant, and equipment, and we need to do it a number of times. We need to do it 10 times. So it's a bit of work when we need to do this. For instance, these $2 million are going to be depreciated into 10 years. This, just so you know, this depreciation is going to go in the income statement. We've talked about that. And the CapEx is going to go in the future cash flows, in the forecasted cash flow, that it's going to affect both the IRR, which is going to go below 15, and we're going to also include it in the operating cash flow and the investing cash flow. So they're both going to change. Remember, there's no model without units. And we have here 10. Some people choose to have these inputs as a different Excel sheet. They open a new sheet and they use this input. I don't like to do that, because mainly I like to just have the inputs at hand and just in real time see if I change an input, what happens with the model, with the valuation result, or with the IRR. So that's something you have to decide for yourselves. I'm particularly keen on just using the input in one additional column, since the same way I am doing here. I also like to do the models in one just big Excel sheet. I don't like to have I don't like to be jumping from one to the other. Maybe that's because I'm a professor in financial modeling, so I like to just jump up and down, especially using these two trace precedents or trace dependence. And I really like to just double click here and move up and down. But that's just something that you need to decide for yourself. What you do not have a choice. It's very important. You do not have a choice in including units. You do have a choice to decide where to use inputs, or if you want to create 7, 8, 10, or 12 lines. What we're doing here is it's a bit of an annoyance. We need to depreciate each one. We do have an Excel file that does this automatically. I will find it and send it to you, because it takes a lot of time to manually do this. So I'll try to do it as fast as I can, just so it doesn't stop the class from moving forward. But just so you know, this is something we need to do all the time. It's called the depreciation matrix. As I said, we have a way of, we have one Excel file that does this automatically. You just need to plug in the depreciation years. I'll be sure to send it to you after the class is done. So we have here this. We need to manually change each of the years. I'll just be doing that. And this is the depreciation of the recurring CapEx. So everyone who works in financial modeling know this hassle of forecasting the depreciation, which is somewhat ironic, because the depreciation subtract on the income statement, and then it adds itself again on the financial cash flow, but it does have an impact on taxes. So just in order for me to finish here, let me just stop it right there. This is A, this is J, this is K, L, M, N, O, P, which is a famous song for children to learn the alphabet. L, M, N, O, P, L, M, N, and this is this is the letter N, and this is the letter M, M, and this is the letter L. So right now we have it here working. Let me just move this one to the right. I'm almost done with this. Pretty much almost done. So we have here our depreciation matrix. There we go. Probably, I hope I didn't make any mistake just by trying to do it as fast as I can, so we don't get withhold with this recurring capex. What it is a good news is that with this investment, and probably you're not going to have, remember I'll send you one that's called initial. In the initial, we're going to have 10 years of depreciation, but maybe let's just depreciate. If it is an big investment of $40 million, we might want to have a larger depreciation span of probably 20 years. So it would make much more sense for us to have a depreciation of $2 million and a capex of $2 million. That makes more sense than actually just having $40 million depreciated in just a 10-year span. So let me just change this to 20 years real quick. Our IRR will change. Our NPV will change. That happens in models all the time. So let's go to the cash flow statement and let's take the recurring capex. So our recurring capex will be $2 million, and we will have a future problem here. Probably no, because when I built the property, plant, and equipment, I added this cell. So it is closing in on itself. So let's move to the net capex. Our balance sheet is working. It is an increase in assets that represents a cash outflow. It's already working. And then our depreciation, let me just double check where do we get the original number from. And then we just need to change it here on the income statement. You probably see now why I prefer to have the income statement, the balance sheet, and the cash flow statement all in one unit, all in one Excel sheet, and not jumping from one side to the other. That helps me avoid some mistakes of perhaps choosing the wrong data. For instance, this depreciation is comprised by the depreciation of the current capex and the depreciation of the initial capex. So in this particular case, we have a higher depreciation. It has impact on the forecasted tax, but it's something funny about it. It's subtract here, and then we add it again here. I just need to make sure that we're using the same number here and that our balance sheet is closed. And here it works perfectly because it's taking the previous amount of property, plant, and equipment. It adds the capex and subtract the depreciation. So everything seems to be working perfectly. Let us look at the internal rate of return, and it has taken a hit. It lost 1%, and it is now at 14.1. But I'm happy to inform that since we're investing in recurring capex, we now have a project that's going to be with us for a long time. And well, definitely, if a project has the ability to provide the dividends, especially once they finish paying this amount of cash, then we have a project that when they finish the debt is going to be able to pay dividends of $9.54 million. And that's something we need to take into consideration. It's a very valuable project / company. And we can assume that after a year, 2030, especially with the recurring capex, is going to turn a project into an ongoing concern, which is why we can evaluate now this project as if in 2030, this project becomes a valuation, a company valuation. And it's something that's very attractive to a private equity fund, to a company that says, look, if you do this project, go into another country, build a subsidiary, and you go into a greenfield project, and maybe 5 to 6 years later, it's going to become a company that, depending on the size of the project, you can well, I'm going to exaggerate a little bit. You can do an IPO and just take it to the stock market and put it as a traded company, or you can resell it to another. So this is something that we do. So I'm going to add two things here. I'm going to add a valuation that's going to move across time. So I'm going to combine some concepts of company valuation with financial project evaluation. So I'll need your full attention for this section. First, I'm going to start with something. And since someone in this class said something about startups and a startup valuation, we're going to do with a startup valuation. Let's assume that this project was a startup, and instead of $40 million in 2026, it had been suffering in the past, I don't know, maybe 5 to 6 years. And finally, the operational cash flow of the startup is positive. So let's indulge me and think that this is not a project, but this is a valuation of a startup that is finally starting to see the light from a negative operational free cash flow to a positive free cash flow. And you might start to wonder, well, what's different about startup valuation? And what's different is that valuators in startups usually, and I include myself among those, we love something called the EV to revenue multiple, which is extremely simple. It's the most simple way we have to evaluate the startup. So pay attention what I'm going to do here. I'm going to open whatever artificial intelligence I'm going to have. I like to use Gemini, but for a reason that's weird, when I open ChatGPT, it shows, okay, Google's also doing that. It shows everyone what I have been looking for with the intelligence, with the artificial intelligence. So I don't want everyone in class, especially this class being recorded, so everyone on YouTube, if I decide to upload this, see what I've been asking the artificial intelligence, like where should I go on vacation, etc. So we go to any artificial intelligence and ask, please provide a suggestion. Please provide a suggestion of an EV to revenue multiple. I'll show you EV what means in just a couple minutes. Please provide a suggestion. But since the person we're talking about that works in a startup here used to work in investment banking, then he knows what EV means, which is enterprise value. Please provide a suggestion of an enterprise value to revenue multiple for a startup I'm going to make the segment up in the drug biotechnologies, in the drug biotechnology sector.
Felipe, can we use maybe
$1 million below break even? Let's place $1 million below break even, and revenue of $5 million. So look, even though I'm telling the artificial intelligence, even though I'm telling Google that the company does not have a profit, I'm still asking for a valuation. What I'm asking for is just give me a number that I can multiply the revenue that is by definition positive times a number of years. So I just click enter, and then we will have a long conversation about what should be considered this revenue. And they say, well, if you have 5 million in revenue and in losing $1 million, I would suggest 5.5 to 7 as a reasonable suggestion, 7 years of revenue. Let me just kill the valuation. And you're not going to like this. It is located in LATAM, in Latin America. And since we don't have a secondary market as strong as the US, or our startups doesn't IPO as common as in the US, it's probably going to downsize my multiple all the way down. So negative EBITDA, revenue, just give me the multiple. Risk adjusted. Okay, where is the multiple? Let me just ask again, what is the suggested multiple? It's a long conversation with these things. They're fairly recent though, it's been maybe, okay, it's not changing the multiple, which is good news. And 5.5 to 7x, okay. So let me just go to the lower end of 5.5, and let's take this number. We are not going to value the project in the first 4 years. Maybe those are the stages that probably we can consider in the beginning of the project. So let me just move all the way up to 5.5. I really like this Excel feature of grouping. And then we take the enterprise value. The enterprise value is a concept in valuation, which basically means the asset value or the operations value that belong to the shareholders and the banks. So since revenue belongs to both shareholders and the bank, what we can do here, if we are trying to simulate a valuation, is we take 5.5 times the revenue. So when we work in a valuation in a startup, we need to take into consideration that we're going to take the revenue, multiply it by a number of years, and that's the leeway that investors in venture finance gives us to have a company value, even though we don't have a positive cash flow or even a positive operating profit. That's why it's so risky to become a venture capital, because you're basically funding companies just based on a number of years of their revenue. If you wait long enough for them to be profitable, then the price is probably be sky high, because by that time the company is going to be very, very mature or large enough to find a different set of investors. And what you do in this particular game, in startup valuation, is you get in early, you pay a multiple of the revenues and the company, then you take the risk that when the company goes profitable, or if the company develops a positive DCF, then other investors are gonna try to jump in, but their price tag is going to be way higher than the one you used when you got in the investment. So in that particular case, that's the name of the game. I'm not particularly saying I like it. It's very risky. It's indeed very risky to buy a company based on multiples. This is not an investment suggestion to start investing in startups using EV to revenue, but based on my observation, it's a very common methodology that allows us to at least have some benchmark on what we should be using as a criteria for investing. But it's not that we are going to have always 5.5 to 7. Sometimes we get cases in which they pay all the way up to 10 years. And we have seen crazy numbers like 70 years or even 100 years. So there's a lot more to the methodology that we would like to admit. But since this is not per se a startup valuation class, but more a financial modeling class, I'm just going to leave this here as a sample, that the enterprise value is, by startup valuation, it would be crazy insane. It would be $630 million. And since the enterprise value belongs to the banks and the equity holders, we need to subtract debt, but it is net debt, because what if we own $30 million, but we have $30 million in cash? Then we don't own anything. So let us just subtract debt. This number is going to be a crazy valuation. I mean, I shouldn't have used this project as an example for the startup valuation, but it is what it is. I'm too late now to take it back. Where's the debt? Where's the debt? We can't. Here's the debt. By year 2031, the expected debt is $30 million, and according to our model, we would have in cash the sum of $7.3 million negative. Sorry, we forgot to add more debt when the company started using recurring capex, which might be a problem, because maybe the company, we will need to ask for more years, or maybe a new debt in the future. So let me just check the amount of cash that we need. You see, I have here, we need to add more debt, but I'm not gonna overcomplicate the model. Maybe just assume that this debt negative is just an increase in debt, or I could add an extra cash from the partners if that would be the case. So let me just go back here. Let me close here. And this is the equity value. This is the equity value. And we take the 643 minus debt plus cash, and we get a valuation of $604 million. If we were in Colombia, this would make more sense, because we would be saying is, look, I am a small company still. I am selling 169 million, which is $30,000. So my valuation is $125,000 pre-money. And that would make more sense than actually valuating a company that sells $116 million as a startup. But in the US market, we've seen worst. And worst meaning we've seen companies with higher revenues valuated as startups. Talking about, for instance, Snapchat. And now that I said the word Snapchat, I can't help to look what's the EV to revenue of Snapchat, that I believe is not profitable still. What's the EV to revenue of Snapchat? The EV to revenue of Snapchat is, let me see if it's between the range of 5.5 or 7, is 2.4 to 2.8, which may rule based on the recent data. I could also search for it in Yahoo Finance. It has fluctuated. It has a median of 11.8. So I told you before, it's not an exact science. It's more of a craft. That's Damodaran. And let me ask if Snapchat is profitable. Which I think it's not, but it's been a while since I asked. Okay. It reported a $9 million income. And this year, significant loss of 1.32 billion. So a company that reported a loss has a value of 2.8 years in revenue as an enterprise value owned by the banks and equity holders, which is pretty common. It happened on Uber for a lot of time, and this year they surprised with a huge profit. So that's one of the challenges of finance modeling of startups, that they give you a surprise. You think they are giving a loss of 1 billion, and then next year, surprise, our profit is $3 billion. And they knew it all along because they built a model. And since you're an outsider to the company, you don't have access to that particular model in which they forecast when or how are they going to be profitable. So let's say goodbye to startup valuation. That was just something that was not in my plans, but you mentioned it in the break. Let's go to another type of valuation that I like more, makes more sense in this particular project. Let's take this revenue minus COGS, which is cost of goods sold, excluding depreciation. I don't know why I said the word valuation there. Minus SG&A, excluding depreciation, which is we get the cost of goods sold, excluding depreciation, selling, general, and administrative, including depreciation, and this is one of my favorites. Not one of my favorites, actually, it's one of everybody's favorite, which is the EBITDA valuation. The EBITDA is hidden somewhere in our model, and actually there's a challenge. I usually challenge my students in the masters to get from the EBITDA to the cash flow, which is a fairly common challenge in investment banking. Is, look, here is the EBITDA, that's the earnings before interest, tax, depreciation, and amortization. And one common challenge is, can you go from the EBITDA to the final cash flow? And in that particular challenge, they have, because it's mostly a homework, they have to get from the EBITDA to all the way to the final cash flow. I'll leave that for you here in this model as well. I'll send it to you, like I said, so you can just, if one day you're being challenged to find the free cash flow just starting from the EBITDA, then you are able to just go back to your Excel file. Just remember the date, October 10, and then just go back here. This is debt payment, and here let's take our this is the free cash flow, the period cash flow, not the operational cash flow. That's it. What I'm trying to do here is replicate from the EBITDA the end of the cash flow statement that we have above. So that's another challenge that I'll do just in a couple of minutes once we finish the EBITDA multiple. So we have here the EBITDA multiple. The EBITDA is owned by the banks and the shareholders. How do you know? Well, it's before interest. So we go all the way up here to the revenue. We go all the way up here to the revenue. Makes sense. The revenue is owned by the banks and the shareholders. We go to the COGS, cost of goods sold. So we take this number here. As you may notice, I do not use the depreciation in the EBITDA. Then I go to the right. I take selling, general, and administrative. If only life was as simple as this model. Just by showing you a quick example on Pfizer, and I just showed like 10 or 20 time traps. I call time traps those things that I do in class, that when we face a real life evaluation or a real life valuation, you have to waste an entire morning or afternoon just fixing one little difference, like the one I showed you before when we're doing Pfizer. But in this particular case, we have the EBITDA. We have no problem. Let's look at the EV to EBITDA, enterprise value to EBITDA, which belongs to, like I said, the banks and the owners. I wish I didn't have this negative cash. It's tormenting me a little bit because in this particular case, it's like we're asking more money. It's like we're asking more money to the banks. So I just use that recurring capex too soon. But let me ask artificial intelligence suggest an EV to EBITDA. Suggest an EV to EBITDA for a chemical company. I'm going to do a quick change of company, quick change scenario. Suggest an EV to EBITDA for a chemical company in Latam, sales of 100 million. And let's say it's profitable. It is profitable. It is profitable. Obviously, since we're asking for an EV to EBITDA, it should be profitable. 6 to 8, suitable, like it. It's a suitable suggestion. Let's take 6. Let's take enterprise. Let's change that outrageous. Let's change this outrageous valuation. That's for startups that can double their revenues each year. So suggest an EV to revenue. So we can change the number before. It's probably going to suggest a slower number. 2.4 to 3, which makes a little bit more sense. Let's just check 2.4. We're going to have two different valuations. We're going to have one that's $94 million of enterprise value, and this one is $280 million. I still think is fairly high. I would suggest something more of a 1 or 1.2 EV to revenue, since it's a chemical company in this new example that I just made up in my mind. Let me just ask for a company like Dow Chemical multiples, EV to revenue, and EV to EBITDA. Usually we don't talk this much to Gemini. We just go to Yahoo Finance and just choose this section here in statistics. For instance, if we want to check Pfizer, we go to statistics, and Pfizer is worth 10 years of EBITDA and it's worth 3 years of sales. So you can incorporate that into your decision. As we were, for instance, there was a time when it was worth 41 years of EBITDA, which would be really confusing for someone who's just starting in valuation. Okay, let me see Gemini. What's the EV revenue? 0.82. Yeah, from 0.75 to 1.70 with a median of 1.11. So this particular area of relative valuation or multiples, it's highly dependent on your experience as a valuator. Perhaps if you work in investment banking, you start doing enough deals and doing a lot of comps, just so you start to know in your head reasonable multiples that you can close deals on, and hopefully get your return on or cover the expenses of the firm or whatnot. So let me just go here. We have debt, we have cash, we have debt, we have negative cash, which is a strange part of this model. We can add something different later. I'm not sure we can add more debt to it because debt in turns needs to be paid, but we can definitely do that if we have enough time to fix this negative cash flow. Minus plus $55 million. And we have here, let me just see what I'm doing wrong, minus plus 55. And in this particular case, 129, I think it's too big, 54. And what you just saw, what you've just witnessed me doing there is something called fine-tuning evaluation, in which I just move this number to get a more reasonable EV to revenue multiple that matches my EV to EBITDA multiple, which is something which I do a lot of the times, and is close the gap between different valuation methodologies. In this particular case, let me just move here the equity value, and this is what we would use to know how a company is changing its value over time. That is something that we do in financial planning all the time. We say, look, if you fulfill this business plan, the company would be worth $100 million from 54 today, or 55 to $114 million of equity value. And if you think about it, this company is not even asking the partners for any money. So it's basically, what we model here is basically an infinite return. We just take money from the bank, pay it in its entirety, and then we get, with zero investment, we are left with $114 million, which is basically an infinite investor's internal rate of return. So that's what's called leverage. And this is a highly leveraged project. Most of the times, if we have time, we just go back and ask for a more reasonable amount of debt, maybe just not 65, probably 70 million. We just ask $20 million and ask for the partners for the difference. And in that particular case, we have not an infinite investor, not an infinite investor rate of return, but something more between a range of 15 to 20%. That makes more sense. In this particular case, I just added more debt to it. So this number is not negative. That is precisely done so our multiple valuation works. Here we have a valuation of 124, 64 million, and 65. In this particular year, into 2035, if you look closely, you'll see that we have 6.5 in cash and 6.5 in debt. So this is a net debt effect of 0, which makes sense. Let's move to the EBITDA that I promised. If we take this $15 million in EBITDA, you've probably seen like 1,000 posts, very popular posts on LinkedIn, that say EBITDA is not cash. Well, obviously it's not cash. EBITDA is before interest and tax, and cash is all these other movements. But you can move from here to here if you have enough knowledge on financial modeling. For instance, EBITDA. EBITDA goes to interest. That's right here. EBITDA goes to tax, and EBITDA goes to CapEx. EBITDA goes to change in working capital, and if I'm lucky enough, this will be matching our project, our ending cash flow, our changing cash flow would be the appropriate name. So let's go to tax. Let's go to tax all the way here, where the tax is right here, 2.2828. Let's move to the CapEx, which we can find somewhere in our model. The recurring CapEx. The recurring CapEx, let me just find it here, 2.339. Let me just take the change in working capital. Even though I say I don't like using change in working capital, sometimes it just helps to reach the end of a cash flow faster. Let's take new debt. And now the new debt and debt payment. So if I'm lucky enough, we should get the same change in cash as we have in the income statement. No, I'm sorry, in the statement of cash flow. Still getting used to the names. Let me just subtract this and change this. This is positive, and this is negative. And this is from EBITDA to cash flow. And for some reason, let me just double check. If we get to 1.42 million, let me open the group, if that's a word, I don't know. And let's move to the right. We have here the recurring CapEx. Almost forget about that one. Our internal rate of return without the terminal value is probably suffering right now, 8.1%, even though this is a good project. We're not building this project to end in 2036. It's too successful for us to do that. And what we need to do here is just double check if this is the cash flow for the period, which is the change in cash. If we want the name of this model, of this financial model, to match the one with the names that we saw on Yahoo Finance, which is something I've always wanted to do. I've always wanted for my classes to match this format. So this is the opportunity. This is the first class that I'm teaching in English, and then we get changes in cash and end cash position and beginning cash position, which is something I would like to change in the future. So they match this. So you see that what I'm doing here is just basically preparing you for valuing a traded company, which is ending cash flow, which is something that it's very common in valuation classes, including the advanced valuation class in NYU from SWOT and 11, and including most of the master's degrees, especially in the US. So let's move to our final part of the class, which is we're almost done, just 10 more minutes and I'll be done, plus terminal value. And then we'll just move to questions. Terminal value. We go to the terminal value. Let me move this one here. And the terminal value is, what is the internal rate of return of this project if I forecast this from 2036 all the way to infinity? I don't need to add more years. I just need to know the present value of an annuity is the last value times 1 plus the growth rate divided by the discount rate minus the growth rate. I'm going to use, in this particular case, this should be the WACC, the weighted average cost of capital, because the operational cash flow belongs to both banks and equity holders. And the WACC is the weighted average cost of lenders and equity holders. So we get here the terminal value, the last year's terminal value. And here's where things get interesting. We're investing $40 million with the prospect of having at the end an operational cash flow of $100 million. In reality, we're not investing it, it's the bank, but in corporate finance, we tend to build things based on what if things were funded by banks or by equity holders, by equity, and then we just want to swap from one to the other. And the operational cash flow is an internal rate of return of 20.4%, which is above 12%, the weighted average cost of capital. We can then decide the financial structure that we're going to use to finance the project, since this operational cash flow that I built here, if I go back to the model and change the debt all the way to 0, the IRR should not change, because that's why I built an operational cash flow. If I go to the model and I change debt, if you have 20/20 vision, before I zoomed in, if I go and change the debt, you will see that the internal rate of return doesn't change. And that's something that's very useful for us in project financial evaluation. The operational cash flow, or in valuation, the free cash flow to the firm, operates on a level of corporate finance in which we evaluate the operating and investing activities regardless of who funded the company, of who owns the company. That is something that's studied afterwards in the capital structure, meaning the weighted average cost of capital. So let me just go back to funding the $75 million. Somewhere up here, just double click. Let me just, okay, 65. I'm going to use 75 here. So maybe that's why we did have cash, because I changed the number where I shouldn't. And let me just double check here. 75, yes, 75. I should have fed from the number above. So probably we're going to have a liquidity problem again. Yep, we have a liquidity problem again. We need to call the partners. And in order to call the partners, we need to do a capital raise, but we will do that in tomorrow's class when we're doing valuation. Let me just stop the recording right here, and then we'll move to a third part of questions and answers.